stocks are selling off across the board today, continuing their rough start to the second quarter. My next guest says now is the time to keep an eye on the momentum trade as the bull market's risk-reward could be turning on its head. Let's bring in Goldman Sachs' Tony Pasquariello, head of hedge fund client coverage. Welcome back.
Thanks, Scott.
So you say the trend is still higher, but that the risk-reward has changed. In what sense?
So I think we should just kind of level set what's led us to this point, which was a very strong Q1, of course, extended a remarkable run off the October lows that totaled $12 trillion in market cap appreciation. And to put that in context, U.S. GDP is $28 trillion. It was a 99th percentile rally in a 5-month period. So
wow.
Totally extraordinary bulletproof run. At some point, you're going to be due for some consolidation, retracement. Maybe we're seeing a little bit of that today. I would say this. We're still believers. I'm still a believer in the bull thesis. I think the economy remains strong. We're forecasting the better part of 3% GDP growth this year.
Okay.
That might be part of like the local complexity, by the way. A believer that the Fed put is alive and well, should they choose to exercise it. And then in the background, which doesn't matter in daily today, you've got the AI story and you've got the GLP-1 story, which we think have a lot of room. But again, just sober about the fact that risk-reward today is different than it was 3 months ago or 6 months ago. And so where that leaves me with kind of like the tactics of navigating the market is stay in the fight, simplify your portfolio into the parts of the market where you have the most conviction and the highest quality parts of the market, and then take advantage of the fact that options are cheap. Put options are cheap, and so I'd like that pairing of staying in the risk you want with downside protection and move along the path from here.
How much of your undoubtedly bullish view on where we are still is on the idea that we're going to get 3 rate cuts, which you still think we're going to get 3. So if I told you, Tony, we're not getting 3, we may get 2, we may get 1, some say we might get none, what happens to your thesis?
So you've got it. I mean, the official view is they're still going to go 3 times this year, starting in June, 4 times next year, 1 for the road in 2026. We're going to end up with 3.25% terminal Fed funds rate. As it relates to the kind of this year and the near-term sequence, I don't mean to be dismissive of it, right? Because the Fed is the biggest variable in the game. I think if you don't get the rate cuts because the economy continues to be better than expected, I think that's okay. The notion of adjustment cuts is they're nice to have. The notion is they're optional. And so the Fed doesn't elect them because, again, we're printing way higher than trend growth. I think it's okay. Now, it might change the complexion of the rally a little bit. It probably changes some of the mix. It probably involves a little bit of correlation shift. So I'm not dismissive in a world where people have a lot of risk on that's going to be an easy ride. But again, for me, it's always a question of why haven't they elected the put that I mentioned? So
economy's really strong. Fed says, you know what, we don't even need to cut. As I've heard that argument, obviously, too. Why would they cut? The economy is great, but the market has sort of is counting so much on the idea that rates were going to come down. Here we are on a rate-induced sell-off, even though we're well off the lows. And look, United Health is accounting for a lot of the 360 on the Dow. I totally get it. But to your point, the mix, the Russell's getting crushed today. Why? Because rates are up. So it hurts the broadening story in some sense, doesn't it?
It does and it doesn't. I have no problem with the Russell taking it on the chin. I think we all spend far too much time talking about the Russell. And I always remind myself, S&P 500 catches 75% of listed equity market cap. Russell catches 5%. So sometimes I think, again, it soaks up too much airtime.
Much ado about nothing.
Much ado about nothing. I would say if I look at the first quarter, and we would all say, hey, the broadening took place, the long-awaited broadening took place. Yeah. It wasn't just tech and communication services. It was energy. It was industrials. It was financial. If this has a more of a cyclical tilt to it, I think that's fine for those old economy plays. I just don't think it's a Russell story. I think the other important pattern of fact is, and I mentioned this before, if we were sitting here in early January, the market was pricing nearly 7 cuts. Now we're pricing less than 3, and S&P is 425 handles higher than it was back then.